Hello and welcome everyone. I am Vishal Khandelwal and this is the 1% Show. This show is an open ended exploration into the minds of the wisest people around to help us learn to think, invest, and live each day a little as 1% better. You can learn more at vishalkhandelwal.com. My guest today is Kalpen Parekh, the Managing Director and Chief Executive Officer of DSP Mutual Fund. Kalpen was previously Managing Director and Head of Sales and Marketing at IDFC Mutual Fund and has also served in other asset management companies like Birla Sun Life and ICICI Prudential. He holds a master's degree in management studies in finance and a bachelor's degree in chemical engineering. I have known Kalpen for the last 10 years and have always seen him as an unassuming, kind, soft spoken person and a learning machine. In fact, Radhika Gupta, the MD and CEO of Edelweiss Mutual Fund, whom I had hosted in the third episode of this show and who came out with her book Limitless some time back, had a note on Kalpen in there. She wrote how Kalpen, who had spent significant number of years in the mutual fund industry in sales and marketing, made a transition to also oversee investments in his role at first IDFC Mutual Fund and now at DSP. Now, investment is a technical domain and requires a very different skills from sales. So when Radhika asked Kalpen about the transition, he told her that well before he took on the role of CEO, he had realized that if he was to do well in this business, he would have to master the investing side and also know the fundraising aspect. And for that, he was not afraid to take classes to gain this knowledge. In fact, even today, he continues to take classes to master different areas of money management. Radhika writes in a book, and I quote, at his age and the stage in his career he is at, most people would shy away from being in a classroom with kids half their age, but Kalpen is comfortable being a student. And that's one of the best things I like about Kalpen, his penchant for being a continuous learner despite his busy schedule in overseeing one of the largest mutual fund companies in India. In fact, he was also one of the initial supporters of the idea of Safal Niveshak. I thought then, that was like 10 years back, why would a mutual fund CEO already so high up in the on the knowledge chain would want to learn more about the idea of investing, value investing? But after knowing him for 10 years now, I have got my answer. With this and no further delay, Kalpen, welcome to the 1% show and thank you so much for agreeing to do this.
Thanks, Vishal, for inviting me, and thanks for even thinking about a show like this because your 1% show, every time I see various guests and hear them, it is a huge learning curve. And, through this show, you introduced me through the thoughts that Radhika has captured in her book. So I want to say thanks to her as well for, featuring me in that. So thank you very much for inviting and looking forward.
Great, great, Kalpen. So I want to start this conversation with one very important question that got asked in the short yet impactful movie you and your team had created, IDFC Mutual Fund, and I recommend that movie to everyone who wants to learn about the basics and the base idea of saving, investing money. Right? That movie was titled One Idiot, and it's also available on YouTube. And it was a great way to explain the concept of investing very early in your life. So the question that got asked in the introduction of that movie was, "What is money?" Right? And that is my first question to you as well. What, according to you, is the idea of money?
So it's such a simple question, but the answer to that is not very easy. And when I was myself thinking about how to really answer this, it took a lot of time. And money means very different things depending on at what stage of our financial life cycle we are. So if we have money, the meaning of money is very different. And if we don't have money, the meaning of money is very different. So, the context keeps changing. But in my case, being fortunate to manage money for lakhs and millions of investors, as well as having got the advantage of myself learning the principles of investing very early in life and having been able to compound a fairly reasonable amount of money. I think money over time has become purely the ability to be myself and the ability to be authentic and express myself in various parts of life. To me, money is courage because it allows you to speak what you want to speak and it allows you to do what you want to do. I think that to me is the meaning of money.
I think that's a great response, Kalpen. I have been thinking about this idea. So when I first saw that question in your video, right, the 1%, the one idiot
One
kind,
idiot.
the movie, right? So I thought that how could kids be like, and they were grown up kids, right? So they should be knowing about the idea of money, right? But when I got to sit down and answer that myself, it was actually difficult, right? We
Sure.
cannot really simply say that money is a currency note, right? Or it's a fiat money that we all use, right? That is the basic simple definition of what money is, right? But what is the philosophical, or what the real meaning of money is, like you said, right? It is courage, right? It is like a facilitator which really helps you live the life that you want to. And I think that really makes so much sense when you put that in the context of starting to save early, starting to invest early, so that you have ample resources, financial resources, to even think of living a life that you want to do, right? So that's a great definition. What about financial freedom, right? We all seeking financial freedom, right? You and your team are helping people achieve their financial freedom through savings and investments, right? So the second question is, what according to you is financial freedom?
So again, financial freedom is basically comfort for yourself. It is comfort for your family. It is ability to lead your life the way you want. It is also ability to help people wherever as much as you can. And I know this for myself. I've seen again, 4 decades that I have been on earth. Every decade has been different. So, when we were kids, going to school and coming back home very quickly because you had to play a cricket match, but you knew that you cannot afford an auto. So we used to take shortcuts and cross over a river and reach fast. So that was, those were the early thoughts or seeds of why money was important, why financial freedom was important. And I've seen my parents, I've seen my, mother work till 65 years. She retired, on the last day of the retirement age. I've seen my father work till the age of 70. So, when you see the whole idea of financial freedom through the lens of others, it teaches you what it can mean to yourself. And I've seen, in my role as a CEO of mutual fund, or even as a relationship manager of a mutual fund 22 years back, money meant different things. Freedom meant different things. To me, it is again, ability to help yourself lead a life of your choice and hopefully make some contribution to someone else who is in need. And I think that is freedom. Freedom, I think financial freedom also means not having to think twice or too many times. You can act at your first instinct. So I think these are definitions which have evolved with time and experiences. Would be very different again 3 years from now, 5 years from now. But that's how I think about it as of today.
Fair enough. You have a bachelor's degree in chemical engineering, right? And post that you did a master's degree in finance. So tell us that story. What made you give up engineering for an education and then career in finance?
So, I think about this many times, and we are speaking at a point in time where in markets, the sector which is very popular or which has been one of the largest wealth creators is the chemical sector or the specialty chemical sector. And I remember in 91, I had no clue what I wanted to do. I just knew that I have to study because education was the only thing that is an asset for, middle class India. So when my parents said that, after 10th you have to do science, I said, okay, I'll do science. I got my HSC score, and then my dad said that you need to do chemical engineering. Uh, and obviously, I just asked why chemical, why not anything else? Because on one hand, a lot of people that time in my college, the top scores used to be for computers and electronics. But my dad said go for chemical because he said he was in a shipping company, and all the containers in his ships, which were going full, were from the chemical industry. So his view was ये industry में बहुत growth है or you will do well if you become a chemical engineer. There will be prospects and you will get a good job. And in the real world we live year on year, right? We don't really plan too much over the next 10, 15, 20 years. So we take decisions basis what is seen in and around us. So that was the starting point of taking chemical engineering. I obviously didn't have the best scores to get admission in Mumbai, so I went to Pune. Thankfully, my college was on a beautiful hill on the top, on the outskirts of Pune. So I liked the visual appeal of the college. I was not sure about the quality of learning, but this is how decisions are made. That okay, at that moment, what clicks, and went ahead and did my chemical engineering. They were some of the best 4 years that I spent, studying with many people across the country who had come and stayed there. And more importantly, once I became a chemical engineer, I started realizing that the job that it entails is very different than what keeps me excited. So when I came back home to Mumbai and I got a job in a chemical factory, this factory was 2.5 hours away from my home. It was on the outskirts. So today it's called New Mumbai, Navi Mumbai. But in those days, all these places were like very far off, and you didn't have the Ubers or even the money, even if Uber would have been there. So taking a train and going there early morning, waking up at 3:34. So those experiences were not very easy experiences. Then I worked for 6 months in a chemical company, a rubber chemical company next to Nosil in New Bombay, and my job was basically to sit in an automated room and press few buttons and ensure that if the processes are working fine, there are no red beeps happening, and then take a walk between pipelines. So there were no human beings in sight for quite a distance early in the morning. So it was a very different experience, and I realized I'm not in that space to feel that this is what I want to do, because it was not keeping me excited. So I kept on jumping jobs. I used to keep checking every day the Times of India Ascent, which used to have openings for interviews. And then finally, I landed a job in the Taj Mahal Hotel at Kulaba as a graduate engineer trainee. I worked there in their laundry for 4 or 5 months because they had a huge boiler room there, and I was a part of the maintenance team. But again, I realized this is not exciting me. So to run away from what was not exciting, a friend said that the best thing to do is let's give an entrance exam for MBA. So I gave my entrance examination, got selected at NMIMS, and that's how purely accidentally I came into doing management, took MBA finance, and here again I got very randomly selected in my group discussion and interviews because I was very scared being a part of noisy group discussions. There were 15, 20 people just shouting and expressing their opinion. And to be honest, while I'm nervous even right now talking to you, I've always been nervous speaking in a crowd. So I just shut down my eyes and I felt that this is not for me. Let me just give up. And the HR person just said that, gentlemen, you seem to be in some deep thought and we would love to hear your thoughts. So straight away I got an opportunity to speak and something clicked and they hired me. So that's how I got. So that company was L&T Finance, and I joined that company. Worked there for around 2 years. I was a part of their treasury desk. I was managing, a small part of L&T's cash flow and treasury at that point in time. Mutual funds had just begun at that point in time, and we had made a plan. We proposed to the management that we should use mutual funds as a vehicle to spark our surplus money, and we started investing in various mutual funds, and that's how the whole journey began.
Yeah, I think what how you described your life journey, I think also tells me so much about how we invest our money or how we analyze business. Right? We always think it's a straight line to the future, and even for the best of companies, even for the best of people or best of lives, right? We think it has always been a straight line, though it is always a journey of iterations. Right? You get into something, you like something else, and then you change your track and you move forward. And so life becomes a accumulation of all these experiences that we never thought that we are going to go through, right? But when in hindsight, when we connect those dots, right, we realize, okay, we've traveled quite a journey, nothing like what we planned for, right? But at the end, things have all turned out well. uh, Talking about connecting dots, right? So there's this famous Steve Jobs Stanford speech where he talks about connecting dots in the past and never in the future, right? That we want to do mostly in our lives, right? So uh, 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 tell us about those important dots in your past life, right? So one thing that you mentioned about is the focus on education that your family laid upon, right? But which really helped you in your life, right? What are those other important dots that you connect from your past that really have helped you become the person that you are today? Basically, your most important lessons growing up in family, in your career, initial career, all those things, right? So
See, I think I was very, fortunate that born in a family where education was important, frugality was important, savings was important. Both parents were working, and hence the thought always was. So dad used to always say that work is worship. So there were holidays when mom or grandmom would say, "Let's go to the temple," and he would be at work, and he would say, "Our God is work because that is where you earn your money." So some of these concepts and principles were taught very early in life, only through observation and conversations at home. I used to live in a very big colony where there were more than 300 families. So the early days of growing up were all about sports and scores in school because both things mattered. For inner scorecard, the sports scores would be more exciting for me, but to keep parents happy, the report card at school would be more important. So that, really that pressure of keeping me happy and keeping them happy ensured that you know most of us who were together as friends would do things very efficiently. Go to school and finish our studies very efficiently so that we have enough spare time to go and play. And today evening we have Wimbledon in the evening. So I remember in those days, every time there used to be Wimbledon matches, we barely used to get to see in those days. But we would ourselves start playing tennis in the building to just reflect the mood. So with every changing sport, so I think early days were about playing together. So that brought in some sense of working with people together, some bit of competitive spirit, also wanting to excel, wanting to do well, not just being me too. So I think I've been very fortunate to have a very easy sort of journey where whether it was friends or it was teachers or it was parents, the environment around kept on encouraging. And I didn't realize when did I end up in a very nice company. So whether it was L&T to start with, a very large giant at that point in time, and the next step was very interesting, which became a turning point for me. We used to invest in debt funds at that point in time in '99, and bond yields were at 16%, and they started coming down. So when bond yields started coming down, our investments in bond funds earned us around 20% return. So 16 was on account of carry, and another 4 to 8% was on account of mark-to-market gains. All these concepts I know today. That time I didn't know why we were making those returns. That time we just attributed that to skill, that we are good investors, and I could put that in my CV that on that treasury money I made so much of returns. And because we were investing in mutual funds, it so happened that the industry also was very nascent. There were very few international fund houses who had set up a shop in India, and one of them was Prudential ICICI. They were looking for a role which was a link between the investment team and the sales team. They wanted a person as a part of the investment team, but talking to the world outside, because they didn't want fund managers to talk. They didn't want fund managers to be salesmen. They wanted a intermediary role. And since I was an investor in their fund, they asked me that we are looking for this role. Would you like to join? And went through the interviews, and things just progressed. So what I'm trying to highlight here is the fact that interest rates came down, and my investments made money, and I could use some of these conversations or examples in my interview, made them probably feel that okay, this guy knows little bit at so early in his career. So that's how the first starting point happened. And it took only a few years to realize that what we attribute as a skill, what I attribute to my own skill is not always skill. There is another context which is giving returns. So most of the returns are beta. The alpha is very small. So over 22 years, I've realized that if my mutual fund gives 16% return and the index has given 14, 14 has come from beta. Only 2 has come from alpha. So something else plays a bigger role. And I think here some of the big dots that you mentioned started getting edged. I joined this fund industry in the year 99, just when the tech bubble was at its peak, and uh, we were just about to launch a tech fund. And I was sent to Chennai to launch the fund because most people in the Chennai branch had resigned and moved to another role. So I was a fresher. I had no clue what funds are. I was given a 25, 30-page presentation, which was fairly, glamorous. It had all the nice things that we always talk of. It had examples that how India will rule the world, Indian software companies will take over. They are there on Nasdaq screens, so on and so forth. Little did I realize that we were bringing this out when the price to earning multiples were 100 times, and it was more like a bubble. So that was the first experience of getting into an industry at a very high pace, sort of boom. And it was also a time when I remember I went to some, uh, you know, uh, companies to tell them why mutual funds are a good investment instrument instead of keeping your money in fixed deposits, because they are tax efficient, they have liquidity. So clearly the product had great advantages, but awareness was very low. Trust was very low at that point in time because certain fiascos had happened. 97, 98 was also period of scams on one hand. So I remember one experience where one very large listed company today, at that point in time, after convincing the entrepreneur there to invest with us, he gave me a check of 2 crores, and his father took away that check from my hand, and he tore it, and he said that mutual funds अच्छे नहीं होते हैं. So that was the starting point to today when everyone says mutual funds sahi hai. So that was a very big lesson that most people still don't trust us, and if we are able to build on trust, it really will help us do much better. So the learning of peak bubbles, post bubbles, you can lose 80% money. One very big learning I got in the first few years was presentations will always show 30, 40, 50% returns of the past, but actually investors end up losing that type of money if products are timed badly, or if the risk is not understood well. So I think in Prudential, I learned that full experience of launching a fund closer to a peak and what can go wrong. Then somewhere towards the end of my stint in Prudential, 2008 is when I moved to Birla. It coincided with another bubble, which was a local bubble. That the local bubble was about the story of India, capex cycle, India becoming bigger than China. I remember all presentations where we used to show our roads and roads of China and how at one point in time we will overtake them, and why our infrastructure companies will be large wealth creators. And even today I remember, I compare that data point that some of those stocks are not even existing today. So again, the learning of what can go wrong came with some of these experiences. Uh, and then I joined IDFC, which was again a very defining moment. Prudential taught me about scale and profits. I remember my bosses used to say that Prudential wants profits, ICICI wants scale. Now you figure out how you get that. So the mind was trained to think out of the box. The mind was taught how to live with this creative tension, and never think either or, but try to think and. So these were some very important management learnings which I got on the job, and yet being paid on the job. So we were learning at a crazy speed in those days on the job, because it was a very new industry. We were experimenting with concepts. We were experimenting with new ways of communicating the benefits of the category, building distribution, reaching out to investors, communicating in a language. So these were all good, I would say, skill sets that you rarely read in textbooks, but you get to learn on the job. My experience in IDFC was again very interesting because there I learned the whole principle of simplicity. I had my colleague, you mentioned about him, Rishi Kakkar, who was my chief marketing officer. He taught me some of the best principles of marketing. At that point in time, how to talk the language of the consumer, how to talk with simplicity, and not use jargons in our language, because our industry is prone to using words which can overwhelm investors, which can overwhelm our audiences. So these were great experiences. IDFC, I also had the advantage of working with a partner called Netixis, French company, and that gave me my first exposure to international clients and how they think about long-term investing, because that market has seen maybe 5 6 decades more than India. So to some extent, long-term investing has patient capital has evolved there. When you meet global family offices, pension funds, the type of investments they do, and in those conversations or in those journey, I accidentally got in touch with DSV BlackRock. Again, I was very fascinated with the thought of working for a company which has 150-year history in India and the largest size in the world. So these two were the partners, and both brought some very different nuances to the business. So one said, trust and integrity is most important because we've been able to survive for 155 years purely by ensuring that we do nothing wrong. Profit banega ki nahi banega was second step है, client first. So this is what my chairman tells me every second day when I meet him. And interaction with BlackRock was all about the science of investing. It's a passive giant, but the way they take their decisions, the way they use technology to run the firm is something that has been written a lot about. So I think these are experiences. Each stint had very different dimensions, uh, but most clearly over these 22 years, what I have learned is we are dealing with people's hard-earned money, and like you said, when we take decisions, many times we don't even know why are we taking these decisions. So people trust us for when they give their money. A lot of their decisions are not most scientifically taken or very thoroughly researched. In our business, I would say that decisions are still not fully researched when investors decide to buy funds or invest in funds. So the onus becomes more ours than theirs. So while we can say buyer beware, but I think when it is about people's hard-earned money, that concept is not relevant. It has to be sellers beware. We have to play that role with a very different degree of responsibility, and it's a very difficult balance to achieve. And we'll talk more about it because I know some of your questions will lead me towards that. But trust, role of cycles, communication with simplicity. I think these are three very important pillars in what I have become as a professional today.
You talked about, I think, putting the client first, right? I think which is such an important idea when you are actually dealing with money, dealing with someone else's money. It's a fiduciary responsibility that you have, and I'm sure the mutual fund industry has come a long way over the years in terms of getting that right, right? But we still have a long way to cover, and I think insurance industry in India probably need to take a leaf out of the mutual fund industry's idea of taking or dealing with the client as if the client is actually the lead guy and not the seller of the mutual fund product, seller of any financial product. Uh, what other things are since you were leading your company? What are the other things that a mutual fund industry in India is doing to deal better with customers and to ensure that the trust which has been built over the last few years of hard work from your industry actually gets even strengthened going forward? So
See, I think in the last decade, Vishal, there has been series of reforms in the fund industry in terms of transparency, in terms of creating risk boundaries, in terms of cost structures, in terms of making the product very easily accessible across the length and breadth of the country, in terms of the diversity of asset classes that the platform of mutual fund today allows. So, today this is probably one vehicle, and a lot of people don't know about it. It doesn't really get highlighted because people think mutual fund is only equities. The fund industry is roughly around, let's say, 38 lakh crores, of which half of it is equity. The other half is not equity. The other half is fixed income of different tenors. And today, through the fund vehicle, you can invest in a overnight product where a current account can be replaced. You can invest in a money market fund, which can be a replacement to a savings account. You can invest in a simple debt fund, which can be a proxy to fixed deposits. It can invest in hybrid funds for investors who are not yet able to digest the sharp ups and downs of equity. So funds with different degrees of fixed income and equity combination. It gives access to global investing. It gives access to commodity investing, to gold. So you name it, and except real estate in a full way, but rest of the asset classes are largely today available. So that choice is available. Of course, choice can confuse an investor, but today the investor has a choice. Secondly, there is transparency like no other product category or industry. Every month end, you can see where every rupee of an investor is invested through the portfolios, through the fact sheets. Communication has reached a very different sort of scale today because it's a fairly competitive industry, and I think it's an industry with great talent. Even in my own four asset management company experiences, I've worked with managers with very different styles. So the equity can be one asset class, but there are three, four styles, and each style is available today for an investor to really pick and choose. So I think the industry has gone a long way in terms of transparency, in terms of regulation, in terms of cost structures. I remember my brother-in-law is he's the head of actuary in a global insurance company, and he works out of Hong Kong. My many classmates, engineers, are today either in US or in let's say Asia. So on one hand, while passive funds are available to them at low cost, but a lot of them don't even know the existence of these investment vehicles because they are more busy in their day-to-day life. And when they want to choose a fund, the type of entry loads and exit loads, the total cost is 3 to 5%. Whereas in India today, the whole package is available between 20 basis point to 180 basis point per annum. So there is a wide choice depending on you as an investor whether you are evolved or you need advice. So you can mix and match and pick and choose. So I think it fulfills the needs of a diverse set of investors and diverse set of evolution of investors. And to me, even in the last many years, our regulator also has played a very important role in enhancing that transparency. I think most importantly, competition itself has played a very important role to realize that if we don't add value to the consumer um, on two dimensions, one is helping them choose the strategy right, and second, once they choose the strategy right, within a certain time horizon, deliver the right expected outcomes, results, or returns that investors should deserve and expect. So I think uh, there is a lot of self introspection that we do, my peers do, and I can say this today that if you were to put a gun on my head and say you do not need to invest your money in your own fund, but any other fund house or any other fund manager, I can easily count 8 to 10 names. So even if they are competition, but I genuinely feel that there is a lot of excellence that is today getting built in the category, and investors are taking advantage of that. So I think these are some huge gradual slow and gradual transitions that the industry has seen over the last decade.
I think that someone said that if you want to go fast, you go alone, but if you want to go further, you take others along with you, right? So, hearing from you about the fact that you are still willing to look outside your mutual fund if you want to invest your own money, right? I think that's such a heartening thing. So, yeah, great. You mentioned about passive funds and index funds, right? So, you've been a student of Warren Buffett. Who's been quoted as saying that most investors, both institutional and individual, will find that the best way to own common stocks is through an index fund that charges minimal fees. Now, those following this path are sure to beat the net results after fees and expenses delivered by the great majority of investment professionals. Now, from the other side of the table, as a creator and seller of mutual funds, what are your thoughts on index investing, which is widely prevalent in the Western world but is yet to catch up in India? Do you think index investing will be big in India in the future? And if yes, what needs to happen in the Indian mutual fund industry to make that happen?
So, Vishal, in fact, when we launched our first index fund, we wanted to use this quote by Warren Buffett, which he has very popularly highlighted many times, as our ad campaign. But obviously, we can't do celebrity endorsement, and that's again, one of the strong benefits of the regulation of the fund industry, where we cannot very easily draw upon what celebrities are saying. We need to really earn the right of communicating the right rules. I feel index investing has already taken off in India. It will become large like in the rest of the world. Whatever works globally eventually ends up working in India as well. Even while we talk today, so I mentioned around 16 lakh crores is the equity fund AUM, of which around 4 lakh crores is the AUM of index funds or ETFs or the passive category. So it is already 25% as of today. And But of course, a large chunk of this is coming in a central manner, in a planned manner, where the Provident Fund, the EPFO, centrally decides that it wants to invest in ETFs and passive funds. It is still not about individual investors saying that I want to invest in mutual funds, because there it is still about awareness. I think the first thing to achieve is awareness for investing as a concept. The second step is to highlight the awareness of asset classes, and then within that, equity, fixed income, and their benefits. So I think we are still in that journey of education and making the category become more relevant. No, notwithstanding the last 4 or 5 years of growth in terms of new investors coming in stock markets as well as mutual funds, uh, uh, it is still very early because the penetration is still just around 10 to 15%, and we have a long way to go in terms of first making people understand that they need to invest. They need to invest with a long term horizon in mind. Index, active, passive, these are second or third level discussions to be done. Also, the context is different. So when Warren Buffett or a lot of funds globally have become very large and passive, let me bring another context. Active management basically has two barriers to alpha, or two barriers to beat the benchmark. One is cost, and the second one is the human being, the fund manager. Uh, so if the fund manager is good, he can generate alpha. If the fund manager is not good, he will delete alpha. And the cost dimension is obviously going to net off from the long-term returns. But like I highlighted in the earlier question, that SEBI has done a lot of work on rationalizing expenses, and we are probably one of the few countries where, as the size of the fund scales, expenses start coming down. So the first 500 crores, the expense may be 2.5%, but if the fund crosses 5,000 or 10,000 crores, the expense goes down to even 1.6, 1.7. Then in the last decade, SEBI also introduced the concept of direct plan, where investors can still get discerning investors who really know what they want and who want to make decisions on their own. They can get to invest in the best capabilities of a fund manager at much lower cost. So the cost dimension has been neutralized to a large extent compared to rest of the world, where costs are still very high. Rest of the world costs are opaque. There are entry and exit loads. India has done away with entry loads. We were the first country which did away with entry load. So to that extent, the cost dimension has been solved for. The second dimension is the person, the style, the way fund is managed. Now there again, if funds are managed with the right frameworks, the right philosophy, and the right rules, the odds of beating the benchmark are in your favor. Again, I'm using the word odds because nothing is certain. I don't know what will be the end game in 2030, 2040, and 2050. But at least the odds are in your favor if there is a well defined way of investing, which is built around sound first principles, and if the fund manager has the right discipline to follow that process. Some will succeed, some will not. Like in every industry, there will be winners and there will be losers. But I do believe that there is room for both. And there is a very interesting category which has started growing in the fund business, which is the category of rules based funds, or smart beta funds, which in a way code for the good principles. And these decisions are largely then taken as per these rules. Then human intervention is minimized. And these funds are also available at moderate cost. They are much lower than the traditional cost of a active product. So there are passive funds at very low cost. There are these rules-based fund at moderate cost, and then there are active funds at full fee. So today the customer has a very wide range, and then the best category and the best strategy eventually will win. I believe money. There will be two versions which will get created over the next decade. One version will be good fund managers who are able to communicate well and then deliver well. Uh, we have many fund managers who are able to communicate very well but not deliver very well in terms of NAV, out performance. And there are many managers where the NAV performance is good, but the communication may not be good, and hence their voice or their product or their ideology may not reach the consumer, and they may not get the right amount of capital. So that balance is important. So they will, continue to raise assets, and some money will also go to passive funds. So I think right now we are at a stage. I still don't think in binary terms, active versus passive. I look at both in my own portfolio, where which is where my skin in the game is. As of today, I have 90% in active funds, which is a view that the active manager will be able to beat the benchmark. 10% is in smart beta funds. So it is in index minus some stocks which we eliminate basis certain rules. So I still have not moved to the thought of completely buying the index, because index will still have weak companies, companies with some poor governance, bad capital allocation. Uh, so I think that's the way I think about my own investing. But like I said, the investors will have a wide choice and they should celebrate this choice.
I'm sure. I'm sure. That was insightful. One of the most important ideas we talk about in investing is the focus on process versus outcome, right? And of course, the outcome is important, but that's not in our control, like you said. So, as an individual investor, I'm in a good spot not to worry about that. But in running a mutual fund organization with investors and distributors always rooting for a good outcome, and often in the short run, how do you end up evaluating your fund managers, because the outcome is largely in their hands, right? How do you walk this line between process versus outcome? And also, given the pressure of daily NAVs that you must handle in your role as a CEO, how does that affect your own decision making?
So it's taken me around 15, 16 years to know what not to do. It has taken me 15, 16 years to know that once you know what not to do, even if you still keep doing that, it's not going to change the results. So it's better to acknowledge that and plan differently and go back to first principles or sound principles. So it's not an easy balance to achieve. And, ours is a very unique, investments is a very unique industry or category where decisions are taken today based on the past, and the results are going to be tomorrow based on the future. And the results that matter, which is compounding, is so back ended. The real value is created probably after a decade. Uh, how well does my fund or any fund do in the next 1, 2, 3 years, or has done in the last 1, 3, or 5 years? Actually, has no bearing on how would it have done in the next 15 years, because so many things would have changed and evolved over time. So it's a very unique sort of balance that we need to create, and it's not an easy balance. But what we have decided as a team at DSV is to say that, okay, what is in our control? These are dilemmas to have, but if you cannot solve them, no point in worrying about those dilemmas. But what is in our hands, let's try to solve for that. So we go back to first principles. So the first thing that we do is we recognize that short-term performance is random, and hence we decided that we will not measure short-term performance. We recognize that peer group benchmarking is meaningless because peers can have different styles and different styles will work at different points in time. So there's no point in anchoring to peer group. The first thing for us to deliver outperformance is to the index. So we gave up on benchmarking to peers. So we've given up the concept of quartile ranking in our measurement. I do not measure, let me not use the word I because that means it's less institutional. We at DSP measure our investment performance on alpha generation, not on quartile ranks. Number one. Number two, we measure performance on a rolling return basis. So we've given up on point in time performance. So if last 3 months are good, it improves my 1 year, 2 year numbers, or vice versa. We've given up on that, and we measure on 3 year and 1 year rolling. I would have loved to do this on 3 year and 5 year rolling, but here the dimension that we still don't have capital which is willing to just see through first 5 years, and investors also obviously expect more consistency in the near term as well. So 1 year and rolling 3 year, alpha to the benchmark, um, no peer group measurement. And the most important thing is what is the input that will generate the output. Now, that input can be very hazy, can be good English, can be a lot of adjectives, because writing a process is very easy. So, we did this exercise around 4 years back, and this came thanks to one family office in Chicago. So, very old couple, 85-year-old couple, had come to India to evaluate various fund managers, and we were one of them. And they were doing this for their own family office for the last 50 years. And they would be talking to many global fund managers. So, in our conversation, as usual, we started with our standard deck: who are we, and what are we, and our history, pedigree, track record, size of team, feet on ground, present in India, the usual things that we would put. And this old wise man, after the session, told me that I have two observations to make. Everything that you spoke was activity, which is you talk every Monday with your team, you talk every Wednesday with analysts, you meet companies, you visit managements, you attend conferences. These are activities. This is not ideology. I want to know your ideology if you have one. And of course we do have, but we were not even thinking about bringing it out. The second point he mentioned is investing is a business of being a loner. So when you give me these numbers that you have got a 40-member team and 5,000 years of experience, do you think it really matters? Because the best investors in the world are investors who are independent and rational in their thinking and are able to stay away from the herd. So this was a very important input or insight that we learned from someone who has been allocating capital globally. And that's when we went back into our drawing room, and I asked the team that, what is your investment process? And obviously, everyone has his investment process intuitively somewhere in the mind. So we have four different managers and four styles. And I asked one of them that, can you attempt to write it down? And he wrote, and he started writing, and he started writing, and it took him a few days to complete a 12-page document. And then we said that, okay, if you are not there, and if this process has to be applied, what type of stocks will come out of this process, and let us evidence back. Today we have data and technology to constantly validate whether this process has source of alpha or not. And does the process have source of, is the process without you able to generate 2 to 3% extra returns minus expenses over the benchmark? And if the answer is yes, then this is a robust process. Then it is built around sound principles. So that's how we documented our first investment philosophy document. It took 6 months to get the first one out. And then we, did this with all the four styles. It took 2.5 years to do that. Now, one can argue that this is, more about, again, articulation and communication. It has to reflect in our NAVs. And as long as, so what decision I have taken along with the team, looking at base rates, looking at history, that if we are able to get our alpha right on a rolling 3 to 5 year basis on 65 to 70% of times right, I think you're doing a good job. I do not expect my fund managers to generate alpha every day. You can't score a 4 or a 6 every day, especially when you're sticking to a style. So I think that's how we have designed our investment approach. That's how we measure our people. And if you're able to do this consistently, you get rewarded. If you're not able to do this consistently, your reward mechanism comes down. So it has taken me 5 years to achieve this objective. Also, what we have done, partly on our own and partly now as a company, every rupee of our money is invested in our own funds. So for the fund manager, for the management, for the shareholders, for the founders, for the promoters. So that's how you're trying to create more alignment uh, of your money with your investors' money. So these are few steps I think which are in our control. Now, whether it will work or not, I don't know. I can't forecast the future. And there are some investors who appreciate this. There are some investors who say that show me the NAV. If the NAV shows the results, that will give me more confidence. But I think, like I said, my approach has been that stick to first principles and measure people and measure the team on alignment to those principles. Are they, so if they say that this is my process, we buy companies of so and so characteristic, and if the portfolio shows some different companies, then that gets flagged off. But if a fund manager would underperform temporarily for sticking to the process, he is not penalized, he's actually rewarded. So this is an attempt, and I think we've been doing this for the last 4 years now, and gradually started this transition. And I hope this should be able to, create better alignment to medium-term outcomes with investor expectations.
I would like to change track a bit about here and talk to you about or seek your insights on the investing part of it, right? You've been an investor, you've learned about investing in, as I mentioned in the introduction, like you are one of those few lifelong learners that I know in the Indian mutual fund industry, right? So you gave an interview with the Economic Times very recently, right? And you talked about the only universal truth of stock investment, which is that markets fluctuate. I would like to hear more from you on this subject of stock market fluctuations and volatility, which most investors treat as risk when it is not. So, how do you think an investor can deal with this universal truth that markets are going to fluctuate, and how have you learned to deal with it?
So one is observation. Second is using data to read history and not just words, because numbers can convey a lot. So many times we say markets are volatile. Obviously, investor reads it or hears it as markets are risky because volatility is risk for him. But if we are able to show that, visually through data, through numbers, at least you're able to make some impression of the nature of these fluctuations. But let me tell you the genesis of this. I remember, there is this story, and I don't know if this story is really authentic because there is a counter story to this story that this was not the most authentic story, but it doesn't matter because it really helped me in crafting a very good marketing campaign for us, which speaks about this universal truth. So this is a story about JP Morgan being asked in 1914 in front of a very large audience, and I think in the New York Stock Exchange, that what's your view on the economy and the markets? And he goes into a thoughtful meditative pause for 3 4 minutes with his eyes closed, and then he starts to speak, and he utters only two words, and he says markets fluctuate. uh, so over time we've realized that the biggest or the most frequent question that every day everyone is asking, whether in television, whether in meetings, whether in conversations in front of clients, distributors, everywhere, is market kya lagta hai. Having known that bloody no one has a clue of what the future is. But we, give so much of data and numbers to try to predict the future. Uh, so we keep thinking that how can we convert, the reality of the market, the truth of the market in the simplest possible way. And I felt that this anecdote about how JP Morgan explained the whole concept of market in just two words was very appealing. And I think it says the truth. It does not glorify markets. It does not magnify the positive side of the market, because what happens in our business, like Carl Richards has said, that investor returns are never equal to investment returns. Fund returns are always higher, investor returns are always poor, because while markets fluctuate, we only speak about the rosy part of investing. So I, over time, have learned that I would rather be cynical in my marketing campaigns, to show the other side of the coin, because the positive side of the coin is always embedded in expectations, and expectations are generally always high. We've always seen huge amounts of money raised on narratives, on themes, on stories, on campaigns, but no one ever says that you can also lose 50% on the flip side in a short period of time. So the truth is that markets fluctuate. The second truth is that the fluctuations are temporary, and the upsides are permanent. Uh, and the third truth, or the semi-truth to this, is that the upsides are permanent only for good businesses and good capital allocators. The downsides are permanent for bad businesses. So these are just three or four things that really matter in taking the right investment decision. And that's where we, in fact, 3 years back, came up with a campaign, also a hoarding campaign on this whole idea of markets fluctuate. And the whole idea was to highlight that. And then we try to do this, especially when markets are rising, because when markets are rising, they get extrapolated only in one direction. It's very important to balance the other side of the coin and highlight that. So, what we as a team have been attempting to do is to show risk first, is to show downside first upfront. So I remember in 2020 when COVID happened, 23rd March was that huge crash. On 1st April 2020, we reopened our small cap fund. And that fund has a reasonably good long-term history of 13 years and I think some 18 or 19% CAGR return. So the traditional approach would have been to, reopen the fund with that as a marketing message. But we wanted to convey the fact that markets fluctuate more prominently and highlight that small caps have much higher risk. So the launch message was minus 67%. Now, there is nothing which can convey volatility than minus 67% in red blood color, to highlight that, temporarily you can have these type of drawdowns also. So I feel that we will be able to bridge the gap between investor expectations and market reality if we communicate both sides of the coin in a balanced, authentic, and honest way. Nick Murray, one author whose books have really helped me a lot in my uh, quest towards simplifying communication. He always says that all rallies are permanent, all fluctuations are temporary. Uh, but it is important to talk of fluctuations because investors come during phases of rallies, and the asset class being cyclical, the next few years are likely to be years of drawdowns. But if you do not highlight this upfront, an investor will never understand. So what we have even done, Vishal, is we've created a charts tool. We are going to release it shortly for our investors, where you can visually see the NAVs. And we urge investors that see the journey of the NAV first. The journey will show you 33% of times when the NAVs are falling, 33% of times when the NAVs go nowhere for 4 5 years, and then the 33% of times when they actually rise so much that they make up for the first 60 65% of times. And that is the only truth of investing. There is no other truth, according to me. Whether the best of companies have had these phases of zero returns, negative returns temporarily, and then they rise. But investors only assume the rising part and come for one part of the bargain, which is the positive part of the bargain. They rarely buy the second part of the bargain. So the whole attempt of highlighting this through markets fluctuate as a word that we coined was to convey that be aware of volatility. And I'll tell you why do I say this is because when I plot the last 22 years of history of growth of AUM in the fund industry, the first large wave happened in 2000 when where most money went into technology funds and saw capital collapse of 80-90% in NAVs. Second large part of fundraising happened in 2007 and 8, which was again in a bull cycle. Thankfully, this round, a large chunk of fundraising in the last 4 years has happened through SIPs and asset allocation funds, which both mean that the risk is distributed. In asset allocation, the risk is distributed to fixed income as an asset class. Through SIPs, the risk is distributed from a timing point of view. You invest through various valuation cycles. So this also is the evolution of the industry done in a very credible way. So I think that is the long story behind the short campaign of markets fluctuate.
I think getting that communication right, or and also like the other side, the investors community taking that communication well, and actually believing that and actually following through that is such an important thing, right? I've seen being in the space where I am trying to teach people about the idea of long term investing, right? I have tried in my own way to teach why volatility is rather your friend, and the idea of sticking to your game, right? And not fall into those FOMO, fear of missing out effects, and when others are making money and probably you're not making as much money. So people understand the idea of process. People understand what Buffett and Munger and all these guys talk about, the simple rules of investing, right? What really hurts people most, and this is for people who get hurt in investing, is that they waver off from the process, they waver off from the path when the markets are fluctuating, right? That's the time when they actually need to stick to the gun. And you gave that status is about 33% of time the markets are rising, and 33% time they are going nowhere, right? But you still have to stay in the
In those
game
30.
to benefit from those good days that you think, okay, others are making money, I'm not making money. Because the problem is that people move out and people shift their games. They move out to games that they don't understand, right? They move outside the circle of competence. They'll trade even in mutual funds, right? So it may be their need, or probably it may be a requirement for them, right? But I think getting that behavior right is such an important idea which you mentioned. You have been,
Can
I
I
think,
can I
very good.
just add one point before you go to the next
Yes,
question that
yes, yes,
I
yes.
must thank you and Vishal. I've never said this to you, but a lot of these learnings. See, one thing leads to another. One door takes you to another door. I think I read your blog first time sometime in 2012 or 13. I don't remember the exact year. A lot of these first principles, one thing very unique about your blog was it started about talking about first principles, concepts which are lifelong. They are not temporary. They are concepts which work overall, sort of time horizons. And through that blog, I got exposed to a lot of other, relevant teachers of investing. So whether it was going and then reading about Charlie Munger or going and reading, Professor Sanjay Bakshi's blog. All of this, the starting point happened through one particular blog of Safal Niveshak. So I must thank you also for having played a very important role in my journey.
Thank you so much, Kalpin. I'm humbled by that fact, right? And I'm still stuck at those first principles, right? Even after 11 years of writing Safal Niveshak, I'm still writing about first principles because this is what I
They
understand.
don't
And this is what
change.
I wanted to talk to you as well, right? Because first principles don't change, but they're so simple principles that people don't want to accept them because they are simple,
Absolutely.
right? So
Absolutely.
even from the mutual fund industry, this is what I've seen. And that's a heartening thing to note that, and especially because I've seen you working closely with IDFC Mutual Fund in your communication, with DSP in your communication, right? Even when those principles are simple and everyone knows about that, the idea is to keep drilling that down in the investor's mind, so that the investors, maybe not 100 out of 100, maybe 1 out of 100 of those investors are going to understand that those principles really work, right? So I think the idea is to keep going to investors, talking to them about the same ideas, even when most people will say, okay, this is boring, I know that, everyone knows that, how can you charge me fees for talking such simple stuff as a mutual fund company or as a blog, right?
True.
But I think that is what I've learned. First principles is all that it is to investing or anything in life. If you
Absolutely.
only understand the first principle, or like Munger says, the most important models, right? If you can understand the basic ideas from the biggest fields out there, I think you will end up making good decisions. And if you keep at it over a long period of time, I think you'll get what you deserve. So yeah, I think.
Jason Zweig has written this. He starts his article by saying that my job is to say the same truth again and again, but in different words. But
That's
the
right.
truth is still the same.
Truth
I
is
think
told, the
that's what you're
saying.
also attempting to do.
That's right. I hope people more people understand and appreciate that. So that's great. Changing track again from investing to your role as CEO, right? Everyone says things, and even I used to think before I talk to you and before I talk to other CEOs like Radhika, right? That the title sounds very glamorous, right? But you are where the buck starts and you are where the buck stops. You are solely accountable. You are solely responsible. You are the person losing the most sleep, right? So take us beyond that obvious glamour of a CEO's designation and maybe share those two to three non-obvious things you wish someone told you before you became a CEO.
So like I said, Vishal, have been very fortunate that I worked with certain professionals who were either my peers or colleagues or seniors who were probably the best in class. And, my conversations with them were always enriching and a brick in my learning. So, many times people say that गॉसिप करने का तुम्हें टाइम क्यों नहीं मिलता है एंड आई ऑलवेज फील दैट when you're surrounded by people who are so focused on their purpose, on their task, every conversation is something that you're really adding value to yourself. And in that sense, I have really been a beneficiary. So my journey has been far more smoother than one can imagine. While I was reflecting on that question, that yes, it is a glamorous role. What goes behind it? What are the challenges? Obviously, there are challenges of, one challenge that I find is if my core competency is, learning investing principles and applying them and communicating them. The CEO role is not just about these two, three things. It is also about doing five other things, process, platform, technology, stakeholder management, media, regulations. So in a way, you have to spend more time doing things which are not your first area of competence, which are not probably your first area of even interest. But that's the part of the role, and you have to start expanding your horizon and mental toolkit to start learning about these things as much as one can. But thankfully, one very good advice that I got many years back, and even today I get that again and again when I meet my chairman Hemendra Bhai, says build a company of giants, and the next hiring you do has to be better than you. So and I think all the organizations that I worked with, I go back with a lot of learning from each one of them. Every boss that I worked with taught me something so valuable that it has helped me in my execution without really, thinking that, okay, I'm now stuck. What do I do? And today also, when I get stuck, I do reach out to some of them, or I'll go and call up and say, I'm stuck here. Can you give me some, quick idea? When I speak to Nimesh, who is today the CEO of Pro ICICI Prudential, he says that before you come to me, the first question you ask is, have you got people better than you? पहले वो पूरा करो, उसके बाद next step पे जाओ. So constant, focus on hiring great talent. Um, when I talk to Hemendra, he tells me that in his old days when he built a DSP as India's first global investment bank, he keeps telling me that, how do I do my hiring? What type of people do I hire? He keeps telling me that I was just a BCom graduate, but I hired the best of managers from IITs and IIMs, and who really eventually emerged and built businesses. So you're able to balance out for the skills that I do not have by having complementary talent. So that's one thing. If I think whenever I get stuck, I always go back to saying that I'm not alone. I have a team of 460 people, and there are different core competencies and centers of excellence who will contribute whenever I get stuck. But having said that, one learning which I think I still have to improve on, and I wish I was trained for this, would have been to delegate well and to have proper time management. The most efficient leaders manage their time very well. They are able to delegate very quickly and create more productivity and more efficiency. I remember when I joined DSP. 2 days later, Naren wrote a mail to me in the night because he's one person I've learned a lot in my early days at iPro. That I hope you don't, you know, do everything yourself. You need to learn to delegate better. So these are some weaknesses that I have, and I wish I could have learned better and become better early rather than late.
Great. So apart from your role as a CEO, right, you've also been in the sales and marketing side. And I'm going through your Twitter, and you, I think, recently tweeted a series of tweets on your key learnings from David Ogilvy's book, which is Confessions of an Advertising Man. One of your tweets read, "Once a salesman, always a salesman." So you have been a salesman yourself, if I may use that term, given your roles in sales and marketing over the past many years. So, what have been your biggest learnings on how to be a good salesman based on your lessons from Ogilvy and your own experiences of so many years?
Ogilvy's, in fact, today also I was reading this other book, Ogilvy on advertising. So these are some books which are really very refreshing, and because the craft of writing is very differently captured in these books compared to the books on investing many times that we read. So I do, constantly read books on advertising more often, once in a while, so that it brings a better balance. And of course, that book mentioned about his journey, where while apart from many roles that he did, and even when he achieved success in terms of building his agency, he was himself the salesman. He was himself the relationship manager for very, large mandates. Um, uh, I feel that we are all salesmen end of the day, and more so in our industry where I remember when I started my career, the penetration of mutual funds was less than 1%. Today, after 22 years, it is still around 10 or 15%. So there's a long way to go in terms of taking a beautiful concept of investing, long-term compounding, asset allocation to a million more investors around the country. So principles of communication become very important. And when I was reading that book over the last 2 weekends, he's listed down various principles. Some of my big learnings are brevity. Many times, writing in less words is very important. At the same time, he also talks about long form body copy ads where you actually write in detail. So how do you have two opposite styles of writing, but both being successful? So how can you achieve both? So if you're writing a large body copy ad, then the content has to be written in a very different way. It has to reveal a lot more. If you're writing with brevity, Twitter style, again, it has to be very punchy. So, these books have helped me a lot in terms of how do you communicate. And I think one most important experience that I've got over these 22 years, talking to customers, meeting them, whether it is in Paris or Boston, or it is in Bihar, or it is in Agra, or it is in Mumbai, you realize that the fund management industry talks its own language, which is a language it believes is exclusive, but I believe it is a language of exclusion. It excludes a lot of consumers from what we are trying to say because they are largely jargons, and these are not the words consumers use in their homes every day. So when I read some of these iconic books, it brings me closer to the reality that the choice of words we use have to relate with that consumer. Standard deviation means nothing to crores of investors, and we may have slides and slides talking of standard deviation and beta and stuff like that. Um, we follow growth style investing or we follow value style investing may mean a lot to 0.1% of the audience, which is my potential audience, will probably mean nothing whatsoever to 99.9% audience. So how do we bridge this gap? And that is my, big learning as a salesman, that we need to talk the language of the consumer. At the same time, not oversimplify that he misbuys. Many times there is a risk of wrong purchase by having wrong expectations. I remember since I was talking of brevity, many years back, so after every Fed policy or after every credit policy, fund managers and all of us come up with our view document, and that document will be 4 pages, 5 pages, 10 pages. So there was this fund manager at Oppenheimer who came up with his document, which was a blank page, and there was nothing written in it. So obviously, with curiosity, you will turn that page, and the next page had just 3 4 words written in it saying no change in view. That's it. Because he said nothing has changed. I don't have to write just for the heck of writing just because a policy event has happened. So I feel that there is, huge opportunity in cutting down on what we write in terms of quantum and making it simple, making it relatable. Warren Buffett has said, right, that communicate to your audience as if you would want to be communicated. I always see my young sister in that audience. In my case, I always see my father, my retired father, who has, after all the hard work, he's given some money in just in pure faith that this money will be saved. Do you think he's going to analyze the sectoral mix, the standard deviation, the drawdowns, and so on and so forth? The answer is no. So I think as a salesman, my biggest learning is we need to maintain trust, yet become more simple, and communicate both sides of the coin, which is risk and rewards, and how to become better investor. I feel these experiences and exposures have, also made me learn that that investors, the type of questions they ask, our communication is to answer those questions rather than answering or writing what we know. So that gap is where communication plays a very important role. And I think some of these seminal books uh, written for the world of FMCG marketing are highly required in financial services. But let me add a disclaimer, uh, not at the cost of oversimplifying or over promising, because a wrong toothpaste will not harm you, but a wrong investment product can really harm your financial future. So that balance of fiduciary responsibility with simplicity is where lies a very large opportunity.
That's right. I think going with Ogilvy, I think he was one of the his was one of the initial books which I read when I was starting to write for Safal Niveshak, right, and teach people on how to use that simple language to convey the complex ideas. And I remember this quote from him, which I have used many times in my presentation. And he said something like, "The customer is not a moron; she is your wife." Right,
Absolutely.
so I think that was a striking quote, right? You need to be very careful about what you're talking about. You're not thinking that the customer is a fool who's not going to get it. He or she may not be able to get it, but if you treat him or her like your spouse, right, you'll be very careful and very honest
Careful.
in the communication. So that was I think one idea, as you mentioned, right? He may have written it for FMCG companies, but it is so important to apply that in
So Vishal,
financial
if you
services.
remember, during COVID, you did a program with us for a couple of hours on
That's
how
right.
to write better. So I still refer to that content many times, along with a lot of new joinees. And I need to call you once again to take us through that and refresh our principles of simple communication.
I'll be happy to do that campaign anytime. Talking about COVID, right? So we mentioned COVID. We're still going through that pandemic, right? Though things have calmed down a lot, right? But what has been your biggest lesson from the pandemic, both in terms of life and how you look at the financial world out there, and what has changed for you in the post-COVID world from the pre-COVID world that has also changed the way you look at life and investing?
Okay, so Vishal, first I'll talk about the people aspect of what were my very big observations. I saw that we were all working without any disruption because our industry has the benefit of doing everything digitally. So, if you noticed, there were hitches when I started this interview with you, and I immediately called up a colleague of mine who is a part of our tech team. I realized so many faceless people who are the backbone of an organization, who do not have titles, who do not necessarily have the best of compensations, rose to the opportunity, rose to the occasion, took charge, self motivated, and ensured that the company runs and the business runs. So it's not just in my company, but I think everywhere, people punched beyond their titles, beyond their weight, and contributed and really reflected that how in tough times they go beyond their roles and titles and contribute. So to me, that was a very important journey of appreciating how junior colleagues really played their roles very well, took charge. And why do I highlight this, Vishal, is also because COVID was also a time where we were all working from home, and which was not very easy because it's easy for few of us who have a proper setup at home, proper infrastructure at home, or enough space. But most people who live in small homes with larger families and their other spouses or kids also having their own work to be done. So I think that was a very big learning for me how people demonstrated their role and responsibility. COVID also was a very difficult phase, especially the phase two, where we saw a lot of known people, friends, or family members, never coming back. So I've had many such experiences where let's say, my wife's uncle messages in the evening that I'm looking forward to be back home. He's in the COVID ward, and the next day morning, doctor says that suddenly situation has deteriorated. He's in the ICU, and he's never able to talk to us. And all we get is, he's no more. And we've seen everyone going through that. So, COVID has made you value time a lot. It has made you value people and relationships a lot more. And I'm generally a very rational or unemotional person, so never felt these things would affect or bother me. But it has had it's left its mark in terms of how people have gone through it, and why we need to be more kinder to people even in good times, not just in bad times. It's magnified the role of uncertainty. It has made me realize how much we don't know, whether in life, in medical science, or in investing. In March, when lockdowns were announced, we all felt we should be very, very cautious in our investing. And in 3 6 months, we saw markets hitting all-time highs. So most maths didn't work in those 12 months, and it was just a reflection that more often we don't know things, though we imagine that we know these things. So I think these were some of the mixed sort of learnings that I had. COVID also made me realize that gratitude is very important to people around you. We do take a lot of people and what they do for granted. We don't know their realities, their challenges, and those 2 years were actually very challenging and difficult. Yet everyone pulled together. Uh, Also, from my own personal perspective, I used to always live in a rented house for the last 20 years, keeping financial equations in mind that rental yield in Mumbai is only 2%, and my simple debt funds would earn me 7 to 8%. My equity funds would earn me 14 to 16%. Then why should I buy a home? But during those COVID days, you realized it's very important. You don't know how long your own future is, so better to have a proper home, at least as your first property. So it made me buy a house for the first time, um, and I think these were some observations and experiences in those 2 years.
That's great, great observation, especially on the part about kindness and gratitude. I think so much missing, and COVID taught us a lot about that, right? So that's great. Being a CEO, right, leading the organization, you go. I'm sure you go through a lot of hiring interviews, and you must be meeting a lot of youngsters who want to get into mutual funds and who want to progress in their careers. So in a world where the pace of change is just multiplying, even as our formal education system seems insufficient to teach all that is required to thrive, what advice would you offer to such young adults or even students in becoming better versions of themselves, right? So what are some of the key work and life skills they must learn and hone to do well in this in the next few decades?
Rightly, as you said, Vishal, access to knowledge today is infinite. You can learn from the who's who of the world today because they are available, and their content is available, their videos are available, they are available to talk. Unlike 20, 30 years back when we were growing up, access to the best minds was limited. So, I always tell this to my son also, and I say this to myself, I just youngsters, because, we also need to learn every day that there's a lot which is available. So, diversify your learning, but yet let that diversification be such that the focus on what you want to achieve, either in your life or in your profession, is not lost. So diversify enough, but not so much that it is all over the place. Number one. Number two, more is not always good. So while a lot of access is available, but it also creates distraction and confusion. So coming back, so I think it's a balance of learning wide, but not wide enough that you lose your focus and get distracted. I think that's something that I tell people, and I always say that uh, the world is changing. So what made me successful in my first decade of experience will most likely not work in my third decade. I need to evolve. Things are changing. I had gone to Flame around a month back for one program, and the guy sitting next to me was exactly the age of my son. who had completed his 10th standard, and he had deep clarity of what he wants to do, and he was looking at investing from the lens of fundamental investing, from the lens of technical investing and charts, from the lens of quantitative techniques, and many dimensions at the age of 15 and a half. And his approach was that there are many toolkits today available to form an investment decision. I don't want to be anchored to only one style if I can optimize more. So I feel that the world is evolving and we have to improve or enhance our evolution also. So we should not stagnate, be a constant learning machine, but at the same time recognize the boundary conditions and operate within that.
You tweeted recently about your first trip to the US in 2010 when the first thing you bought were used books in best quality. And the first book you purchased was Poor Charlie's Almanac, which I think every investor or decision maker must read. It's one of the best books I've ever read. And so I would like to know from you the most important ideas you gained from that book. So that's first part from Poor Charlie's Almanac. The second part is which are your best recommendations for books to read on investing and outside investing?
One reason to pick up that book was whenever I used to check, it used to be available for 6 or 8,000 rupees. And in US, there is a concept of used books, and many people I've seen buy these books but rarely read them. You will find this book on many people's shelf but rarely opened. You will find security analysis on everyone's shelf but rarely read. So they are mostly available in the most original condition. So I got this book at some 2,000 rupees. So I felt it's a huge margin of safety in that. Can't go wrong. And then it was a delight. I would have read it many times in the last 10, 12 years. And the two, three big principles that it really gave a very different approach to investing also, apart from life, is the principle of risk. That statement where he says, tell me where will I die so I don't go there, is such a powerful statement. And it gels very well with the principle of minimalism, where uh, you first decide what not to do. You first eject ideas or eliminate. So that statement taught me the value of elimination more so in investing, because uh, and then when I apply it with data, when you look at, let's say there are 4,000 stocks in the world to invest, uh, above a certain threshold of quality and so on and so forth, there are only 20% stocks which have generated, let's say, double digit compounding. So data says that 80% needs to be eliminated, whereas we try to select. So when I marry these two, it taught me the value of elimination. The concept of inversion, the concept of invert first, again, is something that I try to think many times. That in business decisions, in investment decisions, it really helps. In fact, we designed one fund with that thought process of tell me where will you die, where we said that we'll choose an index fund and just eliminate all stocks which have a source of poor returns. So bad governance, poor capital allocation, bad shareholders, in consistently poor ROEs. Once in a while they may do well, high leverage. So we said that let's just design a fund like that and apply these principles. So it's had a very deep impact in terms of doing what I do at work. In terms of the list of books, it's a mix of investing books as well as marketing books. I like this book by Rolf Dobelli called The Art of Thinking Clearly. It is I think these are a lot of concepts from Nassim Taleb explained in a very simple way. And there is a debate that it is a plagiarized version, but I don't care. If I can learn something with simplicity, some of the most valuable concepts, the concepts of so many relevant biases explained in just 2 or 3 pages. That book taught me this whole principle of survivorship bias, and which is so prevalent in our business. The concept of recency bias, so prevalent in how we invest looking at last 1 year and 3 year returns. So, there are almost 55 biases which are really applicable to what we do day in and day out. So that is one of my favorite books, and I keep reading it. Um, then I like another book by Rory Sutherland, which is Alchemy. where he gives a very interesting point that the opposite of a good idea can also be a good idea. So it helps you think differently. I like two books on communication and advertising a lot. One is Ogilvy on advertising, and the second one is Damn Good Advice by George Dewey. He's himself a founder of an ad agency. Again, a book which you can finish it in just 1 hour, but some very powerful concepts on communication and simplicity. I like the letter to shareholders by Warren Buffett. I think that has really given a lot of valuable, timeless lessons. And a lot of those lessons are condensed in this very interesting book, which is not really very popular, called The Rebel Allocator by Jacob Taylor. So he's tried to write a fictional story where he's talking to a wise investor who actually is Warren Buffett, but he doesn't say it in that so many words. I like another book called Capital Returns by Ed Chancellor. Uh, uh, has helped me a lot in understanding thematic investing and the concept of cycles. And two other books, one in India, the one by Sudhir Sitapati, who was earlier with HUL and now the CEO of Godrej, the CEO Factory. Is a very good book on decision making and sales, pricing, marketing, advertising concept, simplicity, talking the language of consumers, and a book by Kane Siegel on Apple on their design principles called Insanely Simple. So these are some of my best 10 books over time.
Thanks for the recommendations, Kalpin. Kalpin, we are nearing the end of our conversation. I just like three questions remaining too quickly. First is, what's the single best piece of advice you ever got? And what's the single worst piece of advice you ever got?
Okay, so the worst piece first, because that will save money for a lot of people. In every bull market, there are these one-liners. Like recently, the one-liner was "risk hai to ishq hai," from that TV series Scam. I urge people never to fall for these one-liner. I remember in 2007-8 when these balance sheet poor infra companies were hitting crazy valuations without any cash flows. Someone told me that if you buy these three stocks from Borivali, you will move to South Mumbai, and your travel time of 2 hours every day will be curtailed. So in every cycle, you get advice like this, and I would urge everyone never to follow this advice because I did buy those stocks, and had I only bought those stocks, I would have moved to probably further suburbs in Mumbai, away from Borivali, because they are all down 99% today. So whenever investing becomes so simple, your red flag should wave fast. So that was a very bad advice, and they come in every cycle. One good advice that has worked for me professionally a lot. Actually, it's a saying by someone very popular. I don't remember the name, but it says that weak people discuss people, good people discuss ideas. I'm not saying it in the right words, but the message of that is if we have one life which is very finite. We have always very few years on earth. If they are spent on discussing the right things, good ideas, good concepts, life is more enriched. It adds a lot of value to yourself and to the ecosystem around you. More often we get tempted to discuss people, and that only harms us in our journey, and it also harms other people. So I think this is an advice I've always remembered, and it has really worked well for me.
Mm, Final question, Kalpin. So everyone walks on their own journey of life, and everyone must play their parts well. But what, according to you, is a life well lived?
So I've not really thought so much about it, Vishal, because like I said, I take it one day at a time. And then, like with every passing year, you realize you have less years. So I want to be healthy. I want my son and my parents to be proud that, okay, he's doing the right things. I keep telling my son also, my wife tells me that don't tell him what he should do, just be what you want him to be. So, lead a good life, be healthy, you know, um, have a lot of gratitude for the work I do because it allows me to make money for myself, but also at the same time for a very wide a number of people. So attempt for excellence. I feel very good when I do well in my work because it's not that there is only work to me, but I know that it creates more value beyond value for only myself. and vice versa, I don't feel very good when I don't do very well at work. So bringing that balance, so being very healthy mentally and physically is something that I want to, pursue, and that's an advice I keep giving to myself. Be balanced, and life will have cycles, market will have cycles. You need to be very balanced to navigate that.
So accepting that life will have cycles and market will have cycles, I think that's a great advice to end this conversation, Kalpin. Thank you so much for your time, for sharing your insights. All these like 90 minutes have passed, and so thank you for everything, Kalpin.
Thanks for inviting me, and once again, thanks for everything that you've been doing, Vishal, since the launch of Safal Niveshak, all the way till the 1% show. It has been a very enriching journey for me as a listener as well as a reader of your blog. So thank you so much for that.
Thanks, Kalpin. Thank you.